Hello and good morning. I am Mitch Flax, your host of Deal Hunter, founder and CEO of Net Equity Capital. With me, my co-host, Tom Staub, as usual. Hey, man, we had a pretty exciting weekend with our real estate investor conference.
Yeah, it was, I underestimated how much effort it is to host 9 speakers over 6 hours. But yeah, no, it was great. We had a total of 1,200 signups. 400 people came. At any given time, we had 100 plus people watching the speaker. So yeah, it was great.
Bill Danko, I mean, just the list goes on and on. I learned so much, and probably should have broken it up in maybe two different days. It was definitely overload on content, but phenomenal content. Are you going to be releasing that content so people can actually find this?
Yeah, so we'll put it on YouTube, our podcast, and then we'll blast out anyone who signs up at reiconference.com. Should have that out next week. So if you do want access to that content, get on the list by the end of this week.
Wonderful. So we've got a special guest, my good friend, Rob Anderson from Bridgeview Capital. He is president. I've known Rob a long time. We worked together at a prior life, and I just love to see your success, Rob. It's good to have you on this morning. Thank you for joining us.
Appreciate it, man.
You bet. Rob, you guys have done a handful of different real estate deals. You did the student housing opportunity with TCU and UTA. That seems to be going really well. That was something that we actually talked about on this podcast. You've had a few direct deals in the multifamily space, specifically, value add working class C properties. Tell us a little bit about Bridgeview Capital and tell us a little bit about how you got started in the real estate business. Specifically, you came from a similar background like myself. How did you get involved in real estate?
I had a friend give me the Rich Dad Poor Dad book about 20 years ago. It's the truth. And I was securities licensed since the 90s. Have been selling financial products to the Merrill Lynch's and the Morgan Stanleys of the world for a long time. It's a great job. But it's a job. I wanted to build my assets just like we all do. Started with rental homes, had 4 of them. So plus my own home, was floating 5 mortgages at one time. The wife was thrilled with that. And, eventually I discovered passive investing with professionals so I could still take advantage of real estate without the headaches of the day-to-day work. Once I figured that out, I sold all my rentals and I was out, and I just invest in our deals or other people's deals that I see that I really like now, pretty much full time.
I love it. Yeah. It's interesting. So we talked a little bit about this when we had Mark Zuber on for the Real Estate Investor Conference. He wrote a book called One Rental at a Time. Mm-hmm. And that passive cash flow ultimately allowed you to go out and build your own business. For me, likewise, it's that passive cash flow from that rental income that allows you to that freedom to go out and kind of pursue and build a bigger and better company. So it's great to hear that. Tell us a little bit about Bridgeview Capital. I mean, there's a ton of operators and sponsors in the real estate investment space. Specifically, I see a ton of multifamily opportunities. What's your differentiator? What makes you guys unique?
There's a lot of things that we probably don't have time for right now, so I'll just try to summarize it. But frankly, what bothered me is that people like us didn't have access to this every day. In fact, if you look at the IRA rules, the government's still trying to force people into the public markets right now, which to me is a travesty. So it's like, why is this only in the right zip code, or why is this only at the wealthiest country clubs? And it shouldn't be that way. Less than 1% of accredited investors still invest in these type of deals. It's still not mainstream. It may feel like it to the 3 of us because we live in it day in and day out, but it's still not there. And so I kind of have a passion for this. I hate the whole us, not you kind of thing. And so a lot of what we're trying to do is just bring deals that normally would have been reserved for the institutions to people who qualify so they can take advantage of them. So what makes us different is, I guess we just don't come from the real estate world. My partner was the #1 real estate lender in the country for a while, so he understands real estate inside and out. He's underwritten everything, but he's a banker. He's an economist. I come from the securities world, so I'm just an investor. So we have a construction company, and we do a lot of ground up multifamily and some other stuff too. But it's more about the right deal And does the deal make sense? And does it make sense to investors? And if I can double my investors' money on average every 3 to 5 years, then we're going to grow a successful business and a following, and we're going to potentially change some people's lives. And that's why we do this. That's a lot of why we do this.
I love that. I think you hit the nail on the head. And, I was reading a survey that came out in 2019 by TD Ameritrade that surveyed 315 RIAs about private investments. And really, the numbers were staggering. I think 70% of the RIAs said that they actually had requests or interest from their clients. Yet I think under 20% actually could recall them having private investments in there. And I think it's lack of knowledge, right? And I think that's kind of the uphill battle that you and I and Tom all face in getting those folks access to that. They're going to rely and lean on those financial advisors or registered investment advisors, whatever person that they lean on for that. They just don't understand it. So I think you nailed it. That's a great synopsis.
Yeah, Rob, let me ask you. So you mentioned the concept of picking the right deals, which I agree, right? From my team's perspective, we only have so much capacity to handle deals. So we only pick the home runs that we feel are have the least amount of downside, most amount of upside, and pretty stable on the exit. Just quickly, how do you go about, or what is your parameters for picking a good deal?
The number one thing we're doing is we're trying to find distress. What we did the last 10 years, we don't think is going to work going forward. And what I mean is the typical value add multifamily where you buy something, you throw a bunch of money in it, you try to raise the NOI, and you sell it for a lot more than you bought it for. At least in Texas, is the cap rate situation here, the amount of money that's flooded in here. It's really hard to do a value add deal nowadays. I mean, you've got to go workforce, like Class C, which is a heavier lift. You got to know what you're doing. You got to do ground up construction, which is what we've pivoted to, or you've got to find distress. So Mitch mentioned our student housing deal that we did recently. Well, we bought both of those out of bankruptcy. So we had a great basis going in. So that'll get you that high teens to low 20s return, where nowadays in the value add space in multifamily, at least what we're seeing in Texas, it's hard to do that. I mean, we're seeing low teens. We missed out on a deal, Tom, to your point recently, that paid so much that according to our model, they were only going to make a 9% return on that deal.
Yeah.
It's insane. So,
I was just talking to Mitch earlier before this podcast. Ivy Zellman, great analyst in the market, came out with her concern too around the traditional value add forced equity model of multifamily. You're picking up cap rates of 6, 7, hoping to get 9, 10 on the exit. Like, you don't have much room for error. And when supply chain constraints and labor shortages, inflation, I mean, you really need to know what the hell you're doing if you're going to make those work.
And it's really hard to even for the pros, the best people out to make that work.
That's right.
It's just the financials right now. So what we've done is we've pivoted to a couple different things. We've pivoted to income investments with industrial or triple net leases. We've also pivoted on the multifamily side to ground up construction. Yep. Believe it or not, we're starting to look at office. It's a little early, but it will change. The country's about half and half right now. So, you got to it's very macroeconomic is how we look at things. I think I mentioned our founder is really an economist, and it's really about what do we see. So in Texas, guys, right now, we have about a month of housing supply.
Yep.
And it's even worse where you guys are in Austin, but across the state of Texas, which is where we play in all the major markets in Texas, we look at that, and housing supply is only a month. Yep. In some places less. So there's a dramatic need for suburban neighborhoods. There's a dramatic need for multifamily. Even some of the stuff that you do, Mitch, when you build homes. I mean, there's such a dramatic need for housing that when you do a value add, you're not adding to housing. You're just trying to grow NOI, and that's a little hard based on the entry prices that are out there right now.
Yeah, and I'll just add a piece of it too, right? I myself am looking at a student housing project, GroundUp, and some other stuff as well. From a developer standpoint, there's a lot more risk in doing GroundUp, much bigger margins, obviously longer terms. The benefit of going in existing multifamily is you don't have to go through all the entitlements that you do with GroundUp, right? So you acquire the property, it already has the skeleton, you just have to redo it, but you're obviously paying a premium for that luxury, right?
Absolutely. We're only doing it because we have the ability to. I mean, I would tell you 6, 7 years ago, we wouldn't be doing this.
That's right.
And what I mean is, so we have our own general contractor in house that's HUD approved, and the HUD lending that's out there for multifamily construction is absolutely ridiculous. No shocker, the government did something ridiculous. So I'll give you an example. We've got a ground up construction deal we're doing in North Dallas. They gave us a term sheet of 2.6 on the rate over a 35-year amort for a construction project.
That's free money.
What's the term?
What's that?
What's the term?
It's a 10-year term.
10-year term. I mean, are you building like a Dubai out there? Like what are you building? It's enormous.
It's a 360 unit ground up garden style multifamily.
All right, yes, we're doing the same thing up in north of Austin, but that's a 4-year project. So that's great for you.
We're not going to keep it that long. I mean, we're going to
exactly.
Right, as soon as it's leased and occupied, it's going straight on the market.
100%.
So the idea is 3 years.
Yeah, but about a 10-year, 2.6, 35-year amort. That's amazing.
And I think we got 2 years of IO up front. I'd have to check. Yeah, but it's unbelievable. So that's why we've drifted more, is purely because of the financing that we're able to get through HUD. I mean, there's still other good financing out there, but it does make a big difference.
Every deal out there is kind of dependent on financing. And, Rob, you and I have spoken about it. We've talked about it on the podcast on an asset class in Ireland focused on social housing. That whole deal is anchored by the cost of their debt service, at 2.5%, $300 million at 2.5% on a draw. I mean, that's where you can kind of get that delta between the net operating income and the cost of debt, as well as some of the other operational expenses. But yeah, I mean, that certainly makes it a lot more feasible. You mentioned that you only work in Texas. Are you seeing investors outside of Texas want the exposure to this great nation?
Nice. We are, absolutely. We've got investors in almost all 50 states. And what's interesting, I say we primarily work in Texas. I found a really neat deal outside of the state, but there's so much here. It's hard to leave because of what's going on. We are arguably California from the 80s and 90s. And so the question is that going to continue, and how long will it continue? And if you just look at the statistics, Texas is number one in job growth, and we're number one in population growth, the two major metrics that you look at for real estate, right? Well, I'm going to give you a couple more. We're also number one in GDP growth. We're actually the 9th largest economy in the world now. We just passed up Brazil.
I guess we're slipping there. I thought we were 6th.
No, we were 10. We just moved up to 9.
I think domestically we're going to overtake California here in 3 to 4 years, right?
Well, for the first year ever, they had a net loss in population.
Yeah.
So, and we will see. I mean, obviously they are who they've done a great job where they are historically. They've pretty much flatlined, while Texas is a moonshot right now. But we also are the number one corporate relocation destination in the country. And that's a big thing, because Florida gets a lot of love too, but those are generally second or third locations that are being opened down there. Texas is getting the corporate relocations. And that's what I would argue is one of our biggest differences. And then last thing is, we're number one in manufacturing because we've been number one in exports. And why does that matter? Well, we play in the industrial side of the business too. And so if you look at manufacturing and warehousing and these big 10 buildings that are going up everywhere, which are fantastic income plays, we look at that too, and that's not slowing down at all. The onshoring of manufacturing in the United States, and especially here because of our ports and our rail systems, we've got explosive growth there as well.
I love it. Great insight, man. I really appreciate that. You mentioned the industrial space. I know this because it's something that, I'm very interested in, and some investors that I've spoken with are interested in some of the yield that you guys are spitting off on your Archway fund. I know we can't get into super specifics there, but would you mind elaborating a little bit more and just giving our listeners an idea of your build to suit fund?
Yeah, I would call it a net lease fund. because we're looking for triple net leases. And if the audience isn't familiar with what that is, the triple net is 3 ends, and each end stands for what the tenant is paying, not the owner. And that's what's key about it. So triple net is, it's net of any maintenance or repair, the tenant's responsible for that. It's net of taxes, the tenant pays the taxes, and it's net of the insurance, the tenant pays the insurance. So compare that to a single family home rental, the owner is responsible for all of that, right? Well, here what we're doing, we're structuring leases, and this is very normal in this space, as a triple net lease. So the tenant's responsible for 100% of the maintenance and upkeep of the property, all the insurance and all the taxes. We do as an owner is make sure that they abide by the contract and actually do that. And so that's really all we're doing. And what I tell people, so that there's such a demand for yield that where do you go? You know, the bond market is almost irrelevant right now with where rates are. And theoretically, there's an artificial ceiling to where rates can go that the Fed can do, because if we raise it too high, can we really pay our debt service on all the debt that we have out there? And so people argue there's an artificial ceiling on how high the Fed can go. Maybe it's another point or two, I don't know, but it's probably not much more than that. And so because of that, the bond market can only become so attractive, which is really not saying a whole lot right now. So where do you go for yield? And the institutions, the endowments, the Yales out there, the family offices, they've all almost entirely replaced their bond allocations to real estate. And now they're not doing the fun stuff that Tom's doing with the multifamily and the kind of growthier stuff. What they're doing is they're clipping a coupon, right? They're taking that rent that they're getting from a larger company that has a big balance sheet, and that's now instead of their yield off of the bond, they'd rather own the rent versus the bond. And that's the other thing I always tell people: would you rather own the bond or the rent? If you own the bond of a company and they don't pay the yield, what happens? They take a credit hit. If you own the rent and they don't pay the rent, well, you can kick them out of that facility, and that's a much larger issue for that company. So I'd argue that you'd be in a little bit of a safer position if you own the rent versus the bond. And that's really the idea. So state of Texas, state of mission critical facilities. In other words, is it economically painful for that company to break the lease versus stay there and continue to pay you out for the next 10 years? A little touch there, Mitch. Hopefully that was.
I love it. It's fantastic. I'm learning. So it's great to have you on here. What's the typical range of that coupon that you guys are looking for? And what are some of the businesses? I know when investors hear commercial, you mentioned commercial, everyone thinks of the retail version of what commercial real estate looks like. And that's just a small sliver of the space.
Yeah, completely. You don't want retail right now. I mean, nobody's investing in a JCPenney or anything like that. What you want is something that was, number one, essential. So it never closed during the pandemic, right? And so you're 100% have to have an essential business. Number two, what you want is a mission critical business, meaning that facility is mission critical to their operations. It's their number one. It's either their headquarters or it's their number one manufacturing facility, their number one warehousing facility, or in other words, if they left that, it would really hurt the company. And we're talking about billion-dollar companies here, right? We're not talking about little mom and pops. And so they have the balance sheets, they have the money, they can stay there, they can weather the storm. The last thing I would tell you, you brought up retail. Not all retail is bad. You can't use a broad brush there. For example, it's really about whether you're competing with Amazon. And if you can put something in a box and ship it, then you're competing with Amazon. I wouldn't recommend doing that. If you cannot put something in a box and ship it, you're probably fine. And a good example of that would be the home improvement industry. The home improvement industry has boomed. So the three pieces of retail that made money last year are e-commerce, grocery, and home improvement. Outside of that, not sure I would touch retail right now, unless you're just really a deep value investor. If you're of that mindset, I'd probably say go to office over retail if you want a deep value play. But so that's kind of what we're looking at. We really want warehouses, manufacturing facilities, things where companies have billion-dollar net worths, market values. And this way, we don't have to worry about them going bankrupt. And if we pick good real estate, we don't have to worry about them ever leaving. So it's an uber conservative way to get income. And to answer your question, so our portfolio is paying 7%, and we pay a monthly coupon on that. So trying to find a bond that pays you 7%, I'd like to see it.
Yeah, that's smart. I'll just say on that note, on the fact that your profile of your leasees is essentially big businesses. But when you think about that in terms of the G&A line expense, rent probably isn't that much as a percentage.
Correct.
right?
That's
So when
absolutely
they,
correct.
when they have headwinds, they're not going to quickly bail out of their lease, right? That's so.
We had 0 phone calls during COVID. Not only did they not pay their rent, they never even called to talk about it, because it's such, to your point, Tom, it's such a small line item on their overall
Right.
expense structure.
Yep.
Yeah, I mean, these guys are making 250 million a quarter, whatever it is, and their rent is, call it 140 grand a month.
Yeah. So it's
I mean,
fractional.
it's not even comparable,
Right.
but we like it.
Yeah. You know,
Rob, I appreciate that. Rob, that specifically is called your Bridgeview Archway Income Fund, correct? So
It's
that
a
is an open
BB
fund.
Archway Real Estate Income Fund. Yes.
So that is an open fund where you use that dry powder to go and further acquire new sites, correct?
We've got 4 products. We got 4 assets today. We're looking at getting 10 to 12 total and packaging that up to a bigger fish, because this is the other thing. Whenever you look at something, I always tell investors, look at the exit. You got to understand the exit. This is illiquid money. How are you going to get paid back? I'm sure the two of you can appreciate that. And so the idea is we're going to get 10 to 12 properties in a portfolio and sell it to a bigger fish. Why? Number one, they love Texas. They love industrial. They love triple net leases. But the big thing is they don't want to buy these one at a time.
Right? And they want the contracted cash flow, right?
Well,
so it's already packaged for them, so they can just leverage what you've already done, and you'll get paid a premium, and so will investors. So I think that's kind of the name of the game, and you absolutely you nailed it. I think a lot of business models are working the same way. We'll package a bunch of them together. We'll do the legwork, and then we'll make a premium for that.
Yeah. Yeah.
So I think that's brilliant. Anything else that you guys are working on up and coming that, we'll obviously have you back on the show anytime you want. It's great to have you. I love your insight. I love what you guys are doing at Bridgeview. I can tell you, as somebody who analyzes, probably 5 or 6 deals a week, a lot of those are in the multifamily spaces. Not all operators and sponsors are created equal. I know that, by working with an organization with you, when I bring investors to the table on anything that you guys do, your investor relations team is great. Your onboarding is great. You really have your stuff together. And I think, it certainly is something that you see when others aren't following that same model. So I appreciate what you're doing, Rob. And
Mitch,
really
let me just ask one kind of tangent of a question. Obviously there's a lot of moving parts right now in the market, right? I mean, there's all kind of macro level of risk, and supply chain and nat gas booming now, and oil and inflation in China, and the 10-year going up to 2% potentially. How do you all, your economist partner, how do you consider all these factors in your model and build out some sort of risk hedge in consideration of all these variables?
Good question. What we try to sandbag our underwriting is the best answer I have for you there. And we would rather find a deal that we can feel comfortable at this range, full well knowing we're going to outperform it. Right. And so if I'm talking to an investor, I may say, we really think we're going to go here, but we're never going to put that in writing, because we think that this or this could happen. Right. And we do think the 10-year is going to go up, to your point. However, it's all about location too, right? The micro GDP of your property. So Texas economics are not changing, though, despite some of the national headwinds that we are having with all kinds of things. So you've really got, it goes back to underwriting, right? I mean, you've got to really dig deeper than I think we've had to in the past. And because one bad deal, you're done.
Yep.
Right. One bad deal and you're done. And it's not worth it. And so we invest our own money into every single deal. So I always try to look at this like an investor. My number one question for my deal team: show me the risk. Show me the risk.
Yep. Well, I think too, this goes back to the earlier point. Nice, segue to close out here. But in picking the home run deals or the best deals possible, you can sandbag and have a much higher break-even point. And so again, by picking the best deals, you have the most flexibility, or I guess the most margin of error, and still be able to make a profit. So
absolutely. Yeah. I mean, and knock on wood, we've never not returned a profit to investors or had a capital call. We're really proud of that. So if you look at worst case scenario, can you live with it? And that's one of the questions that we have to answer before we ever pull the trigger.
Yep.
So
Rob, thank you so much for joining us. Really appreciate you. And you guys, thanks for listening. If Rob, where can people find you if they've got any additional questions?
our website's the best way, bbcapitaltx.com. Phone numbers or social sites are all on there, and give us a ring. We'd love to visit with you.
Wonderful.
Thanks, Rob.
Rob,
Thank you, guys.
really appreciate it. Have a great day, and we'll see you guys next week.